We're now going to talk about leases, accounting for leases. And leases is an area that tends to bother people as well because leases and bonds have a lot of similarities in that they're dealing with present value techniques. They're dealing with amortization of things like discounts, premiums, or in this case, a lease liability. What is a lease? A lease is where the lessor conveys the right and risk of ownership to the lessee. It's kind of like I remember back when I started in public accounting, a lot of kids would get a new job and go, woohoo, I got a new job. I'm going to go lease a convertible BMW so I can impress my friends. What is the benefit of a lease? You can buy a nice car, rent a lease, or rent a nice car without actually having any money to own it. But what we're looking at here are different types of leases. We're talking about an operating lease and a capital lease and so on. But it says here a lease is a contract which conveys the right to possess and use the lessor's property for a specific period of time in return for periodic cash payments. Our goal is to recognize the substance over form. It may be a true rental, operating lease, or a purchase and sale, which transfers all the rights and risks of ownership, which is considered a capital lease, also a non-operating lease from the lessor standpoint. This is covered by ASC 840. So when looking at a lease, we're talking about two different people, the lessor and the lessee. As I said in the past, we have lessor, lessee, offeror, offeree, consignor, consignee, bailor, bailee, and so on and so forth. So let's look at the two different parties. Here we have a lessor and a lessee. Again, the lessor leases it to the lessee. Now, from the lessor standpoint, we have an operating lease. We also have a non-operating lease. From the lessee standpoint, we have an operating lease and a capital lease. And now notice we don't call it operating and capital here. It's operating and non-operating. Here, from the lessee, it's operating and capital. Now, on the exam, they love to test capital lease. A lot. Because in the real world, what's happening? Well, in the real world, usually you are leasing an asset. So is it an operating lease, like a true rental, or is it a capital lease? Versus it's not normal or not usual that you're auditing the leasing company because the leasing company would be more on this side. So that's what we're looking at, lessor, lessee. Now let's start out with an operating lease because it's easy and it matches both of them. An operating lease is just a true rental. It's like your apartment. Every month, what do? You debit rent expense, credit cash. Debit rent expense, credit cash. Do you debit the building on your balance sheet? No. Do you pay executory costs called taxes, insurance, and maintenance on the building? No. Do you depreciate the building? No. So all you really have is rent expense. Now, you could have prepaid rent, an asset. You might be late on your rent, called a rent liability, rent due. So you could have a prepaid or a payable, but you don't show the asset on your balance sheet. You're not depreciating the asset. Basically, it is a true rental. So if you look in your notes, for an operating lease, it says a lease where the rights and risks of ownership do not transfer. It is considered a true rental. All right. From the lessor standpoint, the lessor is the guy that owns it. They depreciate the asset. They pay the direct lease costs like commissions, legal fees. They pay executory costs. Yellow in this word because you need to remember them. They are known as taxes, insurance, and maintenance. Those are executory costs. So in an operating lease, the lessor is paying these. A lease bonus, if you paid one up front, then that would be deferred and amortized over the life of the lease. Rent received in advance is considered unearned. So in other words, if there's any rent in advance, that would be an unearned until it's actually earned. Security deposits, if they're non-refundable, refundable. Unearned rental payments are recognized, yellow in the word, uniformly over the lease term. What does that mean? It's kind of like free rent. Let's say, for example, we have a 5-year lease and they want to charge us $10,000 a year. But what they say to us is they say, look, if you move in and sign a 5-year lease, I'll give you 6 months free rent. Okay, then what is this really costing us? Well, it's really costing us what? In the first year, $5,000, then 10, then 10, then 10, then 10. It's costing us $45,000. So our cash payments are going to be 10, 10, 10, 10, 5. But we're supposed to recognize it uniformly, which means equally. So what we have to do is you say 5 into 45 is 9,000. So we're going to recognize 9, 9, 9, 9, 9. That's 45. Sounds German. 99999, right? So we're going to hit 99999. There's your 45,000. That's what I mean by uniformly, and that goes on both sides. The person recording the income, 99999. That's what GAAP says. The person paying it, same thing, 99999. So that's going to be uniformly. From the lessee standpoint, it says lease rent expense is recognized uniformly, which I just said. Lease bonus is considered an asset and amortized straight line over the lease term. Any leasehold improvements, we talked about that in the PP&E fixed asset section and also in the intangible section. I said there if you leased a building and you built a closet, that leasehold improvement would be amortized over the shorter of the lease term, 8 years, or the legal life, 10 years, or the useful life. So let's say the closet's going to live 10 years, but I'm only leasing it for 8. Do it the shorter 8. But let's say there's a 4-year renewal option, and it's likely I'm going to renew. So 8 plus 4 is 12 versus 10. Do it the shorter 10. All right, disclosure. What do you have to disclose in the financial statements? General description of the lease, the amounts that are due in each of the next 5 years, and the aggregate or total beyond 5 years. Okay, so that is called a what? That's called an operating lease. So as you look at that operating lease, notice operating, that's from both sides, lessor, lessee. Talked about it here, bye-bye, bye-bye. Now let's talk about what's heavily, heavily tested, which is this one called a capital lease. Now what is a capital lease? Substance over form. In substance, it's a purchase and sale, even though in form it looks like a rental. So with substance over form, it is where it looks as if it's a purchase even though it's called a lease. So substance over form says, hey, in this case, you're going to recognize both an asset and a liability at the present value of the payments. So if I'm going to lease this building for the next 5 years, then as we learned in bonds, I'm going to have to present value those payments. Well, how do I know if it's a capital lease? There's 4 requirements under GAAP. What are they? TT, BPO, 75 or 90. TT, BPO, 75 or 90. TT, BPO, woo! Now, what does that mean? TT means title transfers. If title transfers, if you get the pink slip to the Porsche by the end of the lease term, you're going to own it, debit asset today. If there's a BPO, what is that? If there's a bargain purchase option, you can buy the asset for a bargain at the end of the lease term, less than its expected fair value. Then the Porsche is worth 30 grand at the end of the lease. You can buy it for 100 bucks. You think you're going to buy it? Yeah, then you're going to own it. That's called a BPO, bargain purchase option. You've got TT, BPO, 75 and 90. What's 75? That says that the lease term is greater than or equal to 75% of its useful life. Now that's useful life at inception of the lease. And then 90 says the present value minimum lease payment is greater than or equal to 90% of the fair market value at inception. Let me write that so you can read it. What does at inception mean? It means at inception of the lease when you first start the lease. So what are they? TT, a BPO, 75 or 90. A TT, a BPO. And I run into people years later and they go, hey, Roger Philipp, TT, BPO, 75. So it's something you'll remember forever for the rest of your life, the rest of your days on this earth. So that's TT, BPO, 75, 90. Those are the requirements. You just have to meet one of the 4. And you debit asset. If you don't meet any of these, then what? It's an operating lease. So if you don't meet these, it's an operating lease, which means all you have is rent expense. If you meet one of these 4, you, the lessee, will debit asset and credit liability obligation under capital lease. So that's what we're doing here as far as looking at all these items. All right. So as we go through it, TT, BPO means title transfers, bargain purchase. 75 means 3/4 of its life, 90% of the value. Now, if it's TT or BPO, you're going to own it. Who should depreciate the asset? Well, in all of these cases, who depreciates the asset? The lessee. But let's see how long. If it's TT or BPO, you're going to depreciate it since you're going to own it over the useful life. If it's 75 or 90, you're not going to own it. It says lease it for 3/4, then give it back. So in that case, you're going to do it over the shorter of useful life or legal life. So the shorter of useful life, legal. Useful life, it's going to live 10 years, but it's an 8-year lease, then do 8 years. So here, if it's TT or BPO, useful life. So let's say it's an 8-year lease, but it's going to live 10. If it's going to live 10, you're going to own it, do 10. Here, it's a 10-year asset, but you're leasing it for 8. At the end of 8, you give it back, then only depreciate it over 8. So that's what we're looking at if you meet any one of the 4. What if you meet all 4? You're going to own it, then do these. So that's TT, BPO, 75, or 90. Now, TT makes sense. Title transfers, you get the pink slip, debit asset. BPO makes sense. You can buy it for a bargain, you get the pink slip, debit asset. 75, 3/4 of its life, makes sense. Now, I mentioned at inception. So you've got to have at least 75. But then there's a special rule that if you're in the last 25% of its useful life, you cannot use criteria 3 or 4. Why not? Because let's say it's a 10-year life, but you're in year 8. So if you're in year 8, that means there's only 2 years left. Let's say I'm going to lease it for 2 out of the 2 years. I'm leasing it for 100% of its remaining life. But guess what? I'm in the last 25% of the life, you can't use it. So again, if you're in the last 25% of the life, you can only use TT-BPO, not 75 or 90. Because there's really not much left. Why not? They figure most of the economic benefits have already been used up, so just use TT or BPO. All right, now what does this mean? 70 and 75 makes sense. Present value MLIP. What's MLIP? Minimum lease payments. So if you are paying at least 90% or more of its minimum lease payments, then you debit asset. So let us look at our notes. And you'll see here it says capital lease, lessee, one of the 4 criterias. We've got TT, BPO, 75 or 90, TT, BPO, 75 or 90. Then it says the beginning of the lease falls in the last 25%, then don't use criteria 3 or 4. Now, as far as hitting this, it says the lessee will record the lease at the lower of. So when we record the lease, we're going to record the new asset at the lower of, and we have a couple of options. So record the new asset at lower of either fair market value or present value minimum lease payments. So it's present value minimum lease payments never to exceed fair market value. Now, what does the minimum lease payment include? It includes, let's say for example, you have a beautiful 80-foot yacht and I want to lease it. So I go, how much for that yacht? You go, well, it's $1 million yacht. I'll lease it to you for the next 10 years for $100,000 a year. So what is my annual payment, my periodic payment? That would be my annual payment. So we'll present value 100, 100, 100, 100, plus any bargain purchase option. If there was a BPO, a bargain purchase option, you present value that as a lump sum. Plus any kind of guaranteed residual value. Now a guaranteed residual value means that I'm guaranteeing at the end of the lease it's going to be worth something. That's called a guaranteed residual value. That's how much I am saying that it's going to be worth. You do not include executory costs, huh? Not executory costs. What are executory costs? Taxes, insurance, and maintenance. You do not include those. Why not? Because those are expensed as paid. Debit, lease, insurance expense, credit cash, right? Because what is it? Executory costs are taxes, insurance, and maintenance. Tax, debit expense, credit cash. Maintenance, debit expense, credit cash. Insurance, debit expense, credit cash. So those are not present valued. They're expensed as incurred. So what do we have to do? We're trying to figure out what to debit our asset for. Present value, minimum lease payments not to exceed fair market value. What are the present value payments? Minimum lease payments are what? Annual payment, bargain purchase option, a guaranteed residual value. Now when I say present value, what rate do you use? You have 2 choices. It's either called the incremental borrowing rate or the implicit rate. Okay, those are your 2 choices. To do what? You use one of these 2 rates to present value this. So what's the incremental borrowing rate? Let's say I wanted to lease that boat. And I went to the bank and I said, hey, I want to lease this yacht. How much? They said, $100,000 a year for 10 years. I want to borrow the money. How much? They said, we'll charge you 10%. So that is called my incremental borrowing rate. That's the rate that I could borrow the money from the bank. The other thing is I go to the guy selling it. Right, lessor, lessee. So I'm the lessee. I go to the lessor and go, hey, I like your yacht. How much? He goes, $100,000 a year for 10 years or $621,000 cash today. Whatever rate where $1 million, $100,000 a year for 10 years equals 621, whatever that rate is, that is the rate implicit in the lease. Who makes that rate up? Obviously the lessor, because the lessor makes up the sales price. So the lessor always knows the implicit rate, the lessee doesn't. So here's the deal. I'm going to use one of these two rates to present value this. You will use the incremental borrowing rate unless the implicit rate is both lower than what? The incremental borrowing rate, and known. Known by whom? By the lessee. Because obviously the lessor knows the rate because they made it up. So that's when you will present value. So if you look on page 3, it says the lessee records the lease at the lower of fair value, the present value of minimum lease payments, which is the periodic payment, the BPO, the guaranteed residual value. Don't include executory costs. To present value, use the incremental, or, unless both, use the implicit if it's both lower and known. Note, the lessor always uses the implicit rate. So the lessor always uses the implicit rate. The lessee will only use it if it's both what? Lower and known. Okay, so what we need to do is we need to then figure out what we're going to record as the lease. Now when we go through this, there's a couple of journal entries that relate to all types of leases. Let's look over here. On day 1, we're going to lease the asset. Day 1. Journal entry is leased asset and credit obligation under capital lease or a lease liability. And you're going to record that for how much? The present value minimum lease payments not to exceed fair value. Then, usually on day 1, you make the first payment. Now, this isn't always the case, but remember when I taught you bonds, I said you haven't earned any interest till the end of the year? But with a lease, you might make a payment right away. So they might say, I want you to make a payment up front. So in that case, the first payment is all what? Let's say you buy a house and they want 20% down. Isn't the first payment all principal? Yeah. So therefore, it should all come out of lease liability and credit cash, because it's all principal. Then we're going to depreciate the asset. Now, who depreciates the asset? Since it's a capital lease, the lessee depreciates the asset. So we're going to debit depreciation expense and credit accumulated depreciation. And you're going to depreciate it on what method? Whatever method you currently use for those similarly type owned assets. So in other words, if it's a piece of equipment, usually use straight line, do straight line. Finally, this is the tricky part, all of the additional payments. Payment 1 plus. All of these, you're still going to be paying cash, but some of it is coming out of lease liability, and some of it is going to be interest expense. Now, think about this. When you're amortizing this out, what method are we going to use? Same thing we did earlier, which is what? The effective interest method. The same thing we learned for bonds. Oh, that's why it's such an important concept. So you can see here, here's day 1, here's the first payment, depreciation. This is where we have to use our effective interest table that I taught you in bonds. So we're going to have to go through and learn that again. Okay, so that's what you're going to see as far as what we're doing. Let's look at this example in your notes about page 4. It says example. We have an 8-year lease of $75,000 a year. The present value of the minimum lease payments is $428,415. What is that? That's the present value of our $75,000 a year for 8 years. Because the gross amount is what? If we're paying $75,000 a year for 8 years, we're paying, what's that? $600,000. But the present value of 75 is $428,415. Which means, again, that if you put $428,415 in the bank, it would grow. So, all right. It says the first payment is $75,000 on day 1. It says the implicit rate is 11%, which is known by the lessee. The incremental borrowing rate is 12%. So which rate are we going to use? You use the incremental unless the implicit is both lower and known. This is both lower and known. We have a 10-year useful life. And it includes a title transfer at the end of the lease term. So you tell me, what kind of lease is this? Well, we've got TT, BPO, 75 or 90. Well, there's a couple of things. It's an 8-year asset. It's going to live 8 years, and you're leasing it for 10 years. So that tells you that it's 8 over 10 is 80%. So that. But it also has TT, which means, boom, we're going to own it. So what do the rules say? It says, if you meet TT, you're going to own it. Are you going to depreciate it? Yes. Since it's TT or BPO, you depreciate it over its useful life. Remember, useful life is 10 years, and the legal life, or the lease term, is 8 years. So if it's TT or BPO, 10. If it's 75 or 90, 8. If it's both, which it is, do 10. So we're going to have to then depreciate it over 10 years. What method? Whatever method they tell us. Alrighty. So let's go through and do our journal entries because we need to see what we're trying to accomplish. All right. So let's go through and see what's happening. We start out and we go, let's lease the asset, and we're going to debit the asset for how much? We're going to debit the asset for present value minimum lease payments not to exceed fair market value, $428,415, $428,415. Then when do we make the first payment? It said day one. So $75,000, $75,000. Why? Because it's all up front. It said the asset's going to live 10 years, straight line depreciation, $428,415 over 10 equals $42,841, $42,841. Okay? This is the hard part. Now we've got to figure out all these other payments. And all these other payments are going to be what? They're all going to be still 75, 75, 75. But we've got to figure out the 75, how much is principal, how much is interest. How much is principal, how much is interest. What method are we going to use? The effective interest method. What is the effective interest method? The same method that we learned earlier in bonds is the effective interest method. So what I need to do now is I need to kind of set up an effective interest table kind of like what we dealt with earlier in bonds. So as we go through this, let's set up our effective interest approach, our effective interest method. Now, you'll see this in the notes. I set up a lease liability times the incremental or implicit interest rate, so I'll say times the interest rate, equals interest expense or interest income. Because remember, one guy's expense is the other guy's income because we're leasing the asset. Minus the cash payment, that's how much we're paying a year, equals amortization of your lease liability. So we're going to amortize it out. So we have a lease liability times the interest rate is your interest expense or interest income minus the cash, 75, 75, 75, 75 equals amortization of your lease liability. All right, so when we look at this, let's start out journal entry. Let's look over here again, journal entry. So we've got debit leased asset, credit lease liability, boom, boom. That's how much we're going to set up our asset for. That's what we owe. What we have to do is amortize this out, but don't forget we're going to make the first payment up front, so we don't owe this, we really owe the net of these two. The asset's still this, but this is our liability. That's record, that's report, net. So we're going to have to go through and figure out what are we recording, what are we reporting. So in this particular case, we start out with what? $428,415. What's the effective interest? It is 11 and 12%. The 11% was the implicit, 12% was incremental. Use implicit with both what? Lower and known. So it's 11%. That equals, no. What did I do wrong? No, because you don't owe 11% interest on 428. You owe 11 on 428 minus 75 because that's your first payment. So minus the 75, now what we have to do is take that amount, which is 353,415, times the 11%. That gives us our 38,876. Minus the cash payment, which was given as $75,000, equals $36,124. Then $36,124 comes down to $317,291 times 11% equals $34,902 minus 75 equals $40,098 minus $40,098 is $277,193, and you could keep going. Notice in a lease, this eventually has to go to zero. Why is it going smaller, smaller, smaller? Because at the end, when you paid off your home, how much do you owe? Zero, zilch, nada. You paid it off. You don't owe anything. So this is getting smaller, 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 down to zero. Notice, just like with bonds, here's your journal entry. So my journal entry is what? I'm going to credit cash of 75. Remember, we have to get rid of the liability, debit lease liability, and lease liability amortization 36,124, and your interest expense is going to be 38,876. And the next year, what is it? 75. And this lease liability is going to be 40,098, and your interest expense goes down to $34,902. Notice every year, as this gets smaller times 11%, this gets smaller. 75.38, 75.34, 75.30, 70. Notice the amortization gets bigger every year. So you can see the amortization is getting bigger every year as the liability gets smaller, because you're making the same payment. That's why, like when you buy a home, in the first few years it's all interest. In the last 5 years it's all principal, because the interest is pretty much paid off. So you can see how the principal balance that you owe goes smaller, smaller, smaller. That's how it's happening. So as we do that, this is our journal entry, which we'll carry on over to here. So our journal entry over here is credit cash, 75, debit, lease liability, 36,124, which you'll see in that table, 38,876. And then again 75, and so on. So that's your journal entry year after year after year as far as how much you're going to be amortizing out. So you can see that there's some similarities between this and also with bonds as well, because there is some overlap in the accounting for that. So you'll see that. Look in your notes there. Now a couple other things I want to mention. Going back to my A, B, C, D, E, F, G. Let's see that. A, B, C, D. Record. I'm recording it at 428. But I report it at 353, CDP. Record, journal entry, report, net of the first payment. Report, report. The other thing that's really important to understand, they've asked you to prepare a balance sheet between current and non-current. So one of the things that you have to understand is how much do I currently owe here? 353,415. But how much of that is current? That's this, current. How much is non-current? That's this. So whenever they want to know current or non-current, you have to go one more year to break it out. I owe you this, that's current, that's non-current, because this plus this is this. So if I'm standing here but they want to know how much is current, you've got to go one more year, because that's due within 12 months of the operating cycle. That's the non-current amount. So if you're breaking down, remember with bonds, it was all due in the term bond, all at the end of 10 years, it was all non-current. If it was a serial bond, some could be due currently. Here, you always have some current and non-current, current and non-current. So that's important to understand as far as how those amounts set up. In your notes, you'll also see depreciation. What's it say there? It says criteria 1 or 2, TT, BPO, 3 or 4, 75 or 90. If it's TT or BPO, you're going to own the asset. Since you're going to own the asset, what does that mean? Well, since you're going to own the asset, you're going to get the salvage value, so take it out. If it's 75 or 90, you're not going to own it, therefore you ignore the salvage value. So take it out, ignore it. Again, useful life versus the shorter of useful or lease term legal. Alrighty, next page, note the liability 353, 36 is current, and 317 is non-current. That's what I just said over here. Of the 353, that's current, that's non-current. What do we have to disclose in the financial statements? A description, the gross amount, and the minimum lease payments for each of the next 5 years, and the aggregate beyond 5 years. Alrighty, let's do a couple of questions on that. Question number 1. Question number 1 says, Lease M does not contain a bargain purchase option, but the lease term is equal to 90% of the estimated economic life. Lease P does not transfer ownership of the property by the end of the lease term, but the lease term is equal to 75% of its life. How should we classify these leases? I already forgot. What is the rule? Let's see right here. Let's sing a little bit again. Let's sing. What is it? TT, BPO, 75 or 90. TT, BPO, 75 or... See, title transfers? No. Bargain purchase? No. 75, lease term? Yeah, that's of the life. 90% of what? The dollars. So remember, 75% of the life, 90% of the dollars. So what they're saying here is, in the first one, it's 90% of the life. 90% of the life? Yeah, 75. Second one is 75% of the life? Yes, 75%. So they're both what? They're both capital leases. Number 2. It says, last sentence first, at the beginning of the lease term, they should record a lease liability of how much? And again, we're using the word record versus report. How much should they record? I'm sorry. Record. Alrighty. On December 31st, Dayco leased a new machine from Pear with the following pertinent information. The lease term, 6 years. Annual rental payable at beginning of the year, $50,000. Useful life, 8 years. Incremental borrowing rate, 15. Implicit rate known by day, 12. Present value of an annuity of $1 in advance at 6%, for 6 periods at 12% is 4.61, at 15% is 4.35. The lease is not renewable, and the machine reverts to pair at the termination of the lease, so they don't own it at the end. The cost of the machine on their accounting records is $375.5. At the beginning of the lease term, they should record a lease liability of how much? All right, so they want to know how much is our liability. Now, what kind of lease is it and why? Is there a TT? No. It reverts back to them. Is there a BPO? No. So we've got to see if we meet 75 or 90. Now it says the lease term is 6 years and the useful life is 8. Let's see here. What is 6 over 8? Is 3/4? Is 75% greater than or equal to? Yes. So we qualify here as 75. Alrighty. Now we're going to be making payments. Now how many years are we making payments and how many years are we depreciating it? Let's see. In this case, we're making payments for lease term is 6 years, $50,000 a year. So the gross amount we're going to be paying is 6 times 5 or $300,000. And that's 6 years at $50,000 a year. All right. It says useful life, 8 years, incremental borrowing rate, 15, implicit. Which rate do we use? 12%. Why? Because it's both lower and known. We're going to use the 12% in order to present value. It says the present value of an annuity of $1 for 6 periods at 12% is 4.61. So 4.61 times 50. So we're going to have $50,000 times 4.61, which gives me something like $235,000. $235,000. The lease not renewable. So basically, debit leased asset, credit lease liability. For how much? Leased asset, $235,000. Lease liability, $235,000. That's how much we're going to record. What do you report it at? Then you're going to make the first payment. Debit, lease liability for 50, credit cash for 50, because we're going to pay that off. But they're not asking to report. They're saying record, 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 $235,000. All righty. In a moment, we're going to talk about another exciting area called non-operating leases, and we're going to look at that from the lessor standpoint. Because what did we just look at? We just looked at capital leases from the lessee standpoint. We talked about operating, talked about capital. Now we've got to look at what we call non-operating from the lessor standpoint. We'll do that in just a minute. Okay, now let's look at a task-based simulation on leases. Now remember, on the FAR exam, you've got 90 multiple choice, 30, 30, 30, and you have 7 task-based simulations, of which 6 are graded, 1 is pre-tested. Of course, you never know which one is pre-tested. Also, you've got about 12 to 15 minutes per task-based simulation. Some will take longer, some will take shorter. What is a task-based simulation? It's kind of like taking a bunch of multiple choice like we just did, putting them together into one bigger problem. If you look at TBS 1, last sentence, I would say read the question first, requirements. It says, prepare the necessary journal entries without explanations to be recorded by Nesbitt for entering into the lease on January 2nd, X2, making the lease payment on December 31st, X2, which is the end of that first year, expenses related to the lease for the year ended December 31st, X2. All right, let's read the background and kind of remembering all the good stuff we just talked about and that we just learned. It says, situation, on January 2nd, Nesbitt Co. leased equipment from Grant. Lease payments are to be $100,000 payable annually every December 31st for 20 years. So we're going to make the payment not at the beginning but the end of the year. Also, it's for 20 years. Title to the equipment passes to Nesbitt at the end of the lease term. The lease is non-cancelable. So let's review. What is it? TT, BPO, 75 or 90. TT, BPO, 75 or a little dancing. So what is it? TT, title transfers. Sounds like a capital lease. Title transfers. The lease is non-cancelable. The equipment has a $750 carrying amount on Grant's books. Its estimated economic life is 25 years. So there's giving us 20 and 25 years. This gets tricky. So we're going to depreciate the asset over what? Remember what we said, if it's criteria 1 or 2, over the useful life. If it's 3 or 4, the shorter of useful or legal. In this case, it's TT, so we're going to depreciate it over what? It's useful life. Useful life is what? 25 years. But careful, when we're making payments for how many years? It's a 20-year lease. So the asset lives 25, but we're only leasing it for 20. So at the end of the 20th year, we've paid it all off. Basically, we're going to own it, but we're going to depreciate it over 25. We're going to have to present value the payments over 20. The rate implicit in the lease, which is known to NSBIT, is 10%. The incremental borrowing rate is 12. What do we use? We use the implicit rate unless the incremental borrowing rate is both what? Lower and known. Lower and known. Known by whom? By the lessee, NSBIT, which it is. So we'll use 10%. NSBIT uses straight line method of depreciation. Straight line, 25 years for the depreciation. And the rounded present value factors of an ordinary annuity for 20 years are as follows. Now, an ordinary annuity. We have an annuity in advance, which is annuity due now. That's when you make the payment at the beginning. Ordinary annuity, where is your arrear? Your arrears at the end. That's the end of the years. That is ordinary annuity or annuity in arrears. It says here for 20 years, 12%, 8%. Now, if I wrote this question, what would I do? I'd give you the present value at 12% and 10%, and I'd give it to you for 20 and 25 years. Because you know someone would have picked the 25-year present value factor, but we want the 20 because we're going to make payments for 20, even though we're going to own it for 25. All right, now which rate? Which rate is lower and known? 10%, 10%, 8.5. Prepare the necessary journal entries without explanations. All right, so when we look at this, first of all, we've got $100,000 a year. The present value factor is 8.5. So we've got $100,000 a year times 8.5 is $850,000 is the present value, the minimum lease payments not to exceed fair market value. So that's going to be the 850. So on day one, what do we have? We're going to lease the asset. We have leased asset, 850, and let's say obligation under capital lease, or I'll just say lease liability, 850. Okay, so that's our first journal entry. The other thing we're going to do, remember we said the asset's going to live how many years? 25 years. So if I take the asset, which is 850 over 25 years, is $34,000 a year. So I'll have some depreciation expense of $34,000 and credit accumulated depreciation 34. Remember, you learned this back with fixed assets, straight lines, sum of the year's digits, declining balance, different types of depreciation. In this case, we've got our straight line depreciation. Now, make the journal entry entering the lease, boom. Make the lease expenses related, there's one of them. Another one, it says making the lease payment at the end of the year, and here it is at the end of X2. So on day one, we make this journal entry. Now what do we have to do? Let's go back to our present value. Remember our table over here, the effective interest, the amortization table? So what do? We start with our lease liability of $850. Now remember, we're going to pay it off. It's like your mortgage. You buy a home. You're going to pay it off over 30 years. What happens? Eventually this goes down, 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 down to zero. So we've got $850 times the interest rate. Which rate are we using? Implicit or incremental? We're using implicit because it's both lower and known. So that's going to be our 10% equals $85,000. The cash payment is we're paying $100,000, $100,000, $100,000. So we're paying $100,000 a year equals $15,000. Now remember, this has to get smaller. So take out the 15, gives us 835. A little dyslexia there. 835. Times 10% equals 83,500 minus 100,000 equals, that looks like what? About 16,500. So if we take out 16,500, and again, we just keep getting smaller, smaller, gives us what, like 67,000? 6 and 7 is 13, 5, yes. So you could just keep going and do the whole thing. Notice the journal entry comes out of here. Now, as I showed you earlier, here it starts big, smaller, 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 smaller. As this gets smaller times the same interest rate, this gets smaller. It's 185, 183, 179, 100. This difference every year gets what? Gets bigger. The amortization gets bigger. That's why when you pay off your home, everyone says, hey, you want to save money in taxes? Buy a home, because your interest expense is tax deductible. So your interest expense is tax deductible. Notice the first year you buy the home, it's all interest, very little principal. At the very end, what happens? So at the beginning, its interest expense is high. At the very last year of your mortgage, there's no interest, right? It's very little. So this starts big and gets smaller, but as your interest gets smaller, you're paying the same amount, more of it comes out of the principal. All right, what's our journal entry? Journal entry comes right out of here. So we've got what? The amortization of that amount. So every year as we make our cash payment, we're going to pay cash of $100,000. Then we're going to take it out of interest expense and lease liability. So our lease liability is going to go down. Here's our lease liability. In the first case, amortization liability is going to come down by $15,000, and your interest expense is going to be $85,000. The next year, and all your entries just come right out of this table. So the next year, we're going to pay $100,000. They didn't ask for this, but we're going to do it anyway. The next year, this is going to go $16,500. This is going to go down to $83,500. So every year, notice this payment, $100,000, still stays the same. But these two, as this number goes up, this has to go down. This goes up, this goes down, because we're still paying the same amount every year. So you can see right here how that kind of flows together. So those are the journal entries they're looking for. In a question on today's exam, what would they do? They'd basically ask you to go through and either drag and drop the amounts. Also, they'll ask you for the categories. So they'll give you a whole list of leased asset, leased liability, and so on and so forth. You drag and drop. If you look at the next question, they just want you to go through and kind of match things up. So for example, you have two different columns. Here it says A, the substance of this transaction is that it consists of two separate and distinct transactions. We haven't talked about that yet. You may have in class, but it's called a sale leaseback transaction, where basically I have an asset, I sell it, but I still need the asset. So I sell it to you, then I immediately lease it back. When I lease it back, I'm now the lessee. It could either be an operating or a capital lease. And then we talk about the deferred gain and what to do about it, but you'll cover that down the road, or you can watch my lecture as well. If you want to watch my lease lecture, just contact my office. You can watch the whole lecture again. Rental payments are recognized on a straight line basis, even though the lease calls for payments that increase over the term. Remember, you want to recognize your rents uniformly. That's an operating lease. C, depreciation expense related to the leased asset is reported on the lessee's income statement over the lease term. Well, when do you depreciate it? You pay executory costs, taxes, maintenance. All of those are going to be in a capital lease as opposed to an operating lease. Sales revenue. The present value of the minimum lease payments less the carrying amount of the leased asset is reported on the lessor's income statement. That's called a sales type lease, which again I haven't talked about so far, but I would in my regular class, and it's in the notes. Called a sales type lease or a direct financing lease. That is from the lessor standpoint, and we talk about how do you know if it's a sales type or direct financing. It has to be one of the four criteria, TT, BPO, 75 or 90. Also has to be collectible and measurable in order for the lessor to take it off their books as if it's a sales type lease. But anyway, those are just a couple of areas just to show you an example of how and the types of questions you would see at the actual CPA exam. Remember, this is just one piece of all of financial accounting. Remembering that, again, this is a 4-hour exam. It includes all your intermediate 1, intermediate 2, advanced government nonprofit. If there's stuff like governmental accounting you've never seen, don't worry about it, because I'll walk you through it so you can see it step by step by step. Again, hopefully you learned lots from my presentations. Study hard, and you too will not only pass this intermediate class, but you'll also pass the CPA exam.